So if you want proof that shit is actually hitting the fan, just take a look at China. China, China, China. I've been talking about China. I did a couple of videos in the past, and it's no surprise that they did rate cuts, right? You're probably wondering, oh, they did a rate cut. That must be a good thing. A lot of people associate rate cuts as a really good thing, right? Easing as a good thing, which it is. Don't get me wrong. I'm not saying rate cuts and easing is not good for the economy. But when you start to cut rates and you start to ease, that signals that, hey, things are not going well. You would not cut rates in an environment where things are going well. You would actually be hiking rates, tightening things, so inflation doesn't go crazy, so you can slow down the growth. But you would cut rates because, yes, shit is hitting the fan, which China did. They did cut rates. And lo and behold, we then got the news a couple days later, Evergrande, which came out filing for Chapter 15. Now, Chapter 15 is all about them trying to protect themselves from U.S. creditors going after them because their debt that they have is under the U.S. law. So they're filing for Chapter 15 because they're doing a couple of some debt restructuring and they're protecting themselves so that the U.S. creditors don't come hard on them. And this news basically spurred the markets, created the sentiment to be quite negative, caused the stock market to sell off a bit, you could argue there. But this is all, we knew this from way before, and this is not new information, right? It's just finally they decided to go with the bankruptcy filing now. Now, before I get more into China, the rate cuts, and what's happening, my name is Daniel. I run an organization called Infravest. If you're new, welcome. If you like content like macroeconomics, investing, trading, markets, subscribe to this channel. I talk about it almost every day. I also have courses that teaches you about macroeconomics, investing, and trading. If you're interested in that, check out inforvesting.com. The link is in the description below. Now, going back to China, what's going on? The signals are there. I said it in the previous videos also. They're in deflation. Inflation's coming down quite hard. The property management company, the Evergrande company, largest real estate company, and many other ones too in China that are not being talked about in the news are also feeling the pinch, filing for bankruptcy, and demand in China is completely contracting. I also discussed about exports and imports within the country completely slumping. Exports have dropped drastically, imports as well. Demand has been falling in China. Clearly, shit is hitting the fan there. They are in a recession. They're feeling the deflation and they're feeling the pinch within their economy. Another thing that I also want to talk about is their foreign direct investment. The foreign direct investment, the FDI, has been dropping quite significantly. And I'll post this article, it's about 2 weeks old, but I'll post this article in the description so you can read up on it. But their foreign direct investment in China, so foreign companies investing in China, has basically fallen to a 25-year low. Among all the high tensions, but most importantly, the demand destruction that's happening, and yes, the competition within China, but most importantly, the demand destruction, the recession that China is currently feeling. And we said this before too, and it's very interesting because a lot of people said that when China would come out of COVID, their COVID lockdowns, that China was going to be the main catalyst for the economy to come back up stronger because all the Chinese are going to fly around, spend their money, and things are going to be fine. And completely wrong. That did not happen at all. And now we're seeing China completely face the problems, face the issues, and also a lot of investment is being pulled out of China. Yes, you could argue that the tensions between the West and the East is one also big reason, but most importantly, the companies that are in China are feeling the pain of this recession, of the global markets, of the demand crunch that is happening right now, right? So in this article, when I scroll down, it says the economy's waning recovery this year has further dampened confidence among overseas firms, which have seen their profits at double-digit rates basically get subdued by consumer demand in the country and has fallen drastically. So a lot of these firms out there are seeing their profits really plunge. We're talking about these overseas firms. In addition, Chinese companies in the car industry are becoming increasingly competitive and cutting into the sales and profits of foreign firms. So you got also competition out there, Chinese competition that these overseas companies cannot handle, and because of this, they will have to pull out, right? So overseas car makers have one of the biggest investors in China. In July, Japan's Mitsubishi Motors decided to suspend its China operations after years of sluggish sales. Mazda, also chief executive officer, said that business is likely to suffer in China due to stiff competition in the world's biggest electric vehicle market. And they talked about also another company, Stellantis NV shuttered its only Jeep factory in China and announced that its Opel brand was pausing a planned expansion. So a lot of these car companies out there are saying, okay, the business that they're seeing in China is completely deteriorating. We're going to stop. We're going to slow down. And that is also affecting not just in China, but you're seeing it also overseas in their other countries. And if you look within your own country that you live in, maybe go around and see. I don't know if you're in the market of looking for a car, but if you go and see that the car prices are still high up there. And yeah, there's a little bit of a change, a little bit of a dip in some of the car prices. Don't get me wrong there, but it's still relatively high up compared to pre-COVID, compared to 3 years back, right? And it's still high up there because a lot of these car companies are, feeling the pinch, the pain. They're pulling out and they're not providing the inventory like how they were before. Yes, there's supply chain issues, there's chips issues as well, chip shortages, etc., etc. But it's very interesting that even with this current demand crunch we're seeing, the prices are still up there. And if you go to some car dealerships, you'll see people are still going out buying as much as they can, or trying to get their hands on new vehicles. And these dealerships are saying that, hey, we're not getting enough inventory while all of this mess is happening, right? I heard one story where one person ordered a car in November of last year and it's being delivered this year, October now. So about almost a year you have to wait in order to get your car. And with the demand crunch that is happening in China, with the issues that foreign firms are feeling with their sales, and a slowdown of inventory, that is not creating a good scenario for the consumer who is going out and buying. Because the companies are feeling the pinch, they're slowing down their production, they're selling less, they're pulling out their investment from China. And if they do that, that's going to create the inventory problem even worse, which is going to cause the prices to still be elevated or maybe even move up higher. To a point till when? When does this end, right? There's two paths you could lead to here. One is, as foreign overseas firms are pulling their money out, taking their money out, they're spooked by what the government is doing. the tensions between West and East, spooked by also the demand crunch that they're facing. And as they're pulling money out of China, they're not only pulling money out of there, they're looking all over the globe as well. China being a very big country, they're looking all over the globe as well and pulling out investment there. So if they're pulling out investment there, that means you need less workers then. If you need less workers, then you have less of the labor there to help fill the demand, plus the inventory issues, the shortages, and that's going to even pinch the consumer even more. Till what point, right? Are we going to live in this environment where inflation is going to be high, where certain goods are going to be high for maybe a decade long? Is that a pathway? Maybe. Maybe it is, maybe it's not, because as there's structural changes, issues happening between the West and the East, these companies feeling the pain in China and they're looking elsewhere to invest or not invest at all because they're feeling the pain. That's definitely going to put a lot of pinch on the consumer and not make the inflation story better. So if that's the case, how does this get solved? That's my question. The only way that this could get solved is maybe there is a very severe recession, maybe a depression, and that may mean that if inflation's still high up, the Fed may have to continue, or the central banks around the world may have to continue to hike rates, or keep things higher for longer, tightening things for higher for longer, until these firms realize that, okay, we need to really, we're already feeling the pain, we need to really make things, slow down on not only our production, but also start to fire workers. And when that starts to happen, where they start to fire workers, maybe then the consumers will even feel more of the pinch, and buying and demand comes to a complete halt, where maybe then the workers come back and say, okay, I'm willing to accept a lower salary, just give me a job. And also the businesses start to say, okay, I'm willing to sell these cars or whatever items for a lower price, and the prices eventually come back down. That's one scenario. I'm not saying it's going to play like that. It can. That's one scenario. Or the second scenario is that doesn't happen, and there needs to be a proper shift where the West finds solution with the East, with China, or they find other countries to fill that gap. Because if that gap continues to stay open and doesn't get filled, or it continues to widen even further, it's not going to solve the problem with inflation, right? The Fed can go and hike rates, but it's not going to stop the inventory issues. Or maybe it will, like the first scenario I gave. Really, you pinch everybody out there. You screw everyone to a point where they're so tight that you can't do anything other than cut everything, your prices, the jobs, and things become such a big disaster, right? The third scenario is, right, as China's cutting rates, if the recession's not that bad, maybe the central banks cut rates next year, and then things pick back up again, inflation, and then they come back and whack with higher rates, even further higher, which means maybe the next wave down, the next recession or whatever, ends up being worse off, and maybe they tackle inflation there. But this is going to be a very difficult job for the central bankers out there, because already one of the biggest countries out there, like China, is feeling the pain, the demand crunch, the foreign direct investment, the investments from foreign companies are being pulled out. They're also looking at their other companies out there, their other offices in the West or other countries, and also slowing down there. And as things start to slow, doesn't solve the inventory issue and inflation, and then to a point where there's a halt, eventually something's going to turn over and completely collapse, and that's where you're going to get the unemployment rate and the job losses really hike up and increase, which then I think may bring in possibility of people starting to say, okay, I'm willing to accept a lower salary or what have you because I need a job now. And maybe they win on inflation there. But what if you get the same scenario in 2020 where that job, the unemployment rate skyrockets, and then you get a massive QE like 2020 or maybe even more. The cycle repeats again. The inflation goes back up, and then it's a even more difficult job for the central banks. Will they do it? Will they not? I mean, there are so many variables out there. It's very tough to see. But the most important thing, if there's one thing to get out of this video, is that China is showing you the signs already of its recession, of its demand crunch. The exports are massively down. The imports, the foreign direct investment that's coming out as well, and lowering. Evergrande also filing for bankruptcy. The signs are all out there. Let me know what you guys think. How do you think this is going to all play out? Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.